Hello everyone. I see a lot of the same faces. That's a good vote of confidence from my earlier presentation. I didn't bore you to death, and you're back for more, and that pretty proud of that. But on a serious note, this is just a continuation of what we were talking about earlier. So earlier I said that RSI strategy that I was talking about would feature pretty prominently today, and I picked it for a reason. I picked it because it reflects remarkably closely what our clients actually do. So assuming that our clients are a good subset of, the retail trader, it's a great way to see, how we can correct, problems that we see in that data. And, I'll go over the specific slides and the information again, but the real truth of it isn't very pretty, and it's difficult to varnish that a lot of people don't make money trading. And if you're not making money trading, if you're in it just for the thrill of it, you get free cocktails if you play a table game over here. So honestly, if you're not making money at this, it's not really worth your time, and that's really what we're trying to get at. So this whole series is, again, built on the fact that the real numbers don't lie, and they're not necessarily pretty. A lot of people don't make money trading. But if we can understand the common mistakes, we give ourselves a much better chance of success. I can't guarantee that you'll do well by any stretch of the imagination, but hopefully through today, and myself and my colleagues will give you a lot of great information that will put you on the right path and definitely help you hopefully become a successful trader. All of that being said, this is a risky business. When you're trading with leverage, you stand to gain a lot, sure, but you also stand to lose a lot. And actually, I have a presentation dedicated to leverage a little later that I highly recommend you attend. I think it's really fascinating stuff. It won't be the plain vanilla stuff you've probably seen before, and I'm pretty excited about it. But leverage is a double-edged sword. You can't risk something that you can't afford to lose, especially when you're trading with something like 50-to-1 leverage. So please keep that in mind. And on a personal note, obviously I put a lot of work into this, and I really believe in what I'm talking about, but at the same time, there's no guarantee that what I'm talking about will work in the future, especially when we're talking about, hypothetical results. Hypothetical performance tells you what's worked in the past. Time and time again, you see that something that's worked in the past doesn't work in the future. So keep that strongly in mind. Just because the equity curve looks really pretty doesn't mean that you bet your kid's college tuition on it. So please keep that in mind, but all that said, let's get right into it. So the title of this presentation is Trading Pairs that Range. And when we discuss client performance and what traders actually do, what we found is that, what I personally found, is that most clients are range traders. That means you buy something when it's cheap, sell something when it's expensive. In more concrete terms, you're buying something when it's oversold, selling something when it's overbought. You're buying something at support, selling at resistance, and what have you. And that works great a lot of the time. The numbers bear it out. On average, traders made 58% winners on the Euro-US dollar. Trades that were closed out at a profit from the third quarter of 2009 to approximately 2009 to 2010, number was at 58%. But there were a lot of periods where that didn't work out well at all. And again, we want to really start to narrow down why that might be the case. And I'm going to focus on range trading strategies because, again, I think that's what becomes most naturally to us. And it's not only what I think, but it's what our data shows, that a lot of our traders really follow the mold of range traders. So when I talk about trading pairs that range, when do they work? I want to focus on, when you stand a chance of when you stand a better chance of turning a profit than when you stand a chance of losing big. So the first chart, a little confusing, I will admit, the daily effects volatility indices. And this is a bit of a sneak peek of what I'm going to talk about a little bit later. But basically, the daily effects volatility indices use what's called implied volatility from options. So I won't get too specific. All you really need to know is that when you have an options price, a big part of that options price is determined by how volatile the trader expects that currency will be through the specific stretch of time. So we take that information and we make the daily effects volatility indices, which is a measure of volatility expectations for a given currency pair. And I'll talk a little bit more about how we're going to use this, or how we can use this in our trading. But I want to give you a general sense that sometimes, like in the earlier example, in the earlier presentation, I talked a lot about the fact that the Swiss franc did extremely well on the RSI trading strategy in 2009, at least hypothetically. You look at the volatility indices and you see they were high, but they were trending lower, which is to say that it was trading during a general period where there wasn't that much going on in markets. Currencies were moving, sure, but at the same time, if you were trading at the time, if you remember back, things were slowly but surely quieting down until the beginning of 2010, right before the flash crash, when things hit the fan again. Overall, 2009 was pretty quiet. Again, the flash crash, when all of a sudden things turned south, things turned a little sour. That's exactly what we saw. Our volatility indices went through the roof. And that basically warrants that what you were doing earlier, again, I don't have the chart here, but if you remember back to my first presentation, I showed you that range strategy did extremely well in 2009. 2010, not so much. 2010, the US dollar Swiss franc performance on the RSI trading strategy was, without a better way to put it, pretty awful. So let's talk a little bit about what we're talking about, range trading, and really the meat of it. When can we range trade? When is it a good idea to range trade? In my earlier presentation, I talked about how if you range trade, you want to keep certain money management. You want to keep it so that you stand to gain at least as much as you stand to lose. And that's a big part of it. If anything, that's the biggest part of trading, in my opinion. Because even if you're right most of the time, if you lose big when you're wrong, you don't stand much of a chance. At the end of the day, you want money management, but at the same time, if you can also try to pick better market conditions for your trading style, that can also go a long way, and that's what I'm trying to get at here. So, talking about market conditions, talking about, when is it a good time to range trade? Here we have a chart of the Euro-US dollar, and on the bottom there, it's what we call the average true range. Average true range, really simple. You basically take the true high or the true low, and you say, on average, how much is the currency swinging from high to low? And the average true part means that you're taking the previous bar's close, if that's higher than the current bar's high. You don't have to worry about that too much because there aren't too many gaps in Forex. But all you really need to know is that when that blue line is high, it means that currencies are swinging big from high to low. Currencies are swinging big, high to low. We're probably moving a lot. Probably not a great time to do something that does well in slow-moving markets. And that's exactly what we're seeing here. You can kind of eyeball it there. There's not much going on for a lot of this time. ATR works pretty well in telling you, okay, the coast is relatively clear. You can play a lower volatility strategy because we're not moving that much. I mean, you can see that towards the beginning of 2008, the average true range of the Euro-US dollar, and that's a 14-period ATR on 14 days, was about 100 pips a day. So from high to low, it was on average moving 100 pips through that 14 days, which is very low by historical standards. And overall, when you see the euro's not going much of anywhere, you're seeing that the ATR stays pretty low. Of course, when the euro does break out, it does break higher, you're seeing that ATR go through the roof. And whereas the euro was moving on an average 100 pips a day previously, it's now moving at its peak about 350 points a day, more than 3 times what it was doing before the onset, before the height of the financial crisis. So this is the kind of information that you really want to use to your advantage. Now, the issue here is actually relatively clear, and I gave you a hint on what I'm going to be talking about with that first slide. But basically, when you use price-based indicators, a lot of the time it's like you're just getting a delayed reaction. I mean, you can see it there. The euro starts moving a lot more before the ATR responds. And if you're just trading off that ATR, you're going to expose yourself to significant losses, because at the very worst time, when the market first breaks out, is typically, in my experience, when it does the biggest moves, that's exactly when the ATR is probably the lowest. You want to be really careful. So, what are we talking about when I say range trading? Let's just take it back a step. Earlier presentation, I said RSI. RSI is, I think, the poster child for range trading. It's really, I mean, as a gearhead, I love things that I can code and play around with and optimize and what have you. But, you know, maybe you don't trade with indicators. Maybe you just trade on price. So I want to give you a good sense of what I'm talking about when I say range trading. So it's pretty simple. So, again, I have the ATR at the bottom just to give us a general sense of how volatile markets are. But in concrete terms, I'm looking at those support resistance lines. And let's say that I'm right here. So right here, I see that the euro spikes higher and pulls back at that high. Let's call resistance at just about the 158 mark. Because we didn't quite close there. There's a wick. 158 is a nice round number. That's our resistance level. And notice that we also set a noteworthy support level right here at 53.50, which likewise more or less coincides with previous congestion support. So we have one resistance level and we have one support level. Right when it tests again, we might take a short position. Didn't work out too great. Price went right through it again. But, okay, it went another 200 points higher. We probably got stopped out there. You know, it happens. You pick up, you dust yourself off and try again, pretty much. Again, we had support and we had resistance and support. Right here on the bottom, you see 153.50. We try to buy here because price had previously spiked lower at that mark. Obviously, hindsight being 2020, this worked really well. And sure enough, we were able to grab it until that same resistance line. Now, obviously, we might have been aiming for 160, but this is where a little bit of discretion comes into play. You might try to play these different support resistance levels. Maybe that's your first target, that's your second target, what have you. Overall, though, range trading working reasonably well here. We flipped. We said, all right, we'll take profit on our long. We'll go short because we tested again. I typically don't like flipping direction on the same pair within a 24-hour period. So for the sake of argument, 158 gets tested again a few weeks, about 2 weeks later. Let's saw it again. Worked out pretty well. Actually, this worked out even better than the previous one because it fell exactly to support. So far, so good. You know, let's flip direction. Why not? Let's take profit. Go long. Great. You know, it went higher. It held support. In fact, it didn't really test much beyond support. So we're in great shape. I mean, if this continues, it's great. Our system is producing profits. We're not really worried too much about losses, even though we suffered a minor one back here. Overall, we're in great shape. So we break through that initial resistance level, but 160 holds again. Let's sell it. Works out great. But, all right, 153.50, our support line. Let's buy it again. Not so much this time. And really, if you remember back to this, the euro tested 160 twice and broke substantially lower thereafter. So maybe you sold that resistance up here, but if you held on to that long position, you were in really rough shape. You were over here. The euro fell a matter of, you know, almost 4,000 pips and not so long. So this is a similar chart, and I've drawn the same kind of style here. I have resistance, I have support. And notice something here. Notice the fact that I add a line down here. I'll discuss what this line is in a second. But notice the blue line is ATR. Remember in the previous slide, ATR was closer to 100. Now it's peaked at 350. But since I said, like I mentioned earlier, ATR and any price-based indicator is a little tricky to use because it's delayed. It won't give you the immediate reaction. It won't give you the fact that price has actually settled down because it's using 2-week-old information, or actually 3-week-old information when you're talking about 14 periods. So while ATR has actually peaked, it's actually a perfect opportunity to start range trading because, again, support, resistance, we can make a killing if we know that this is the right time to start trading. Obviously, the devil's in the details. How do we know it's the right time? You can't know for sure, but in trading, like anything else, you play probabilities. And what I've added here at the bottom is something that I post on dailyfx.com. It's what I call the volatility percentile. So those volatility indices that I showed at the very beginning, I think serve us great purpose. I mean, there have been just a ton of studies in all kinds of markets on how implied volatility from options prices, not limiting ourselves to FX, is actually the best predictor for volatility that you can get. And it's better than any model based on previous price information. Why? Because, like I mentioned earlier, you don't have to understand options to understand the fact that volatility expectations play a huge role, probably the biggest role other than strike price of that option. And if you don't know what that means, don't worry about it. Volatility expectations play a huge role in the price of that option. And when you consider that people are making money or losing money or betting on these options, you can bet, no pun intended, that they're going to have a really good idea or a really good guess on what's going to happen next. So I really like using volatility expectations from options because, again, I always like to think about the motivations behind everything. The ATR is stupid. It has no idea what's going on. It's just telling me what happened in the past 14 days. Obviously, it's just a piece of code. It has no will to tell me the right thing. Whereas an options trader might be making or losing money based on where volatility is. So if I'm going to take that kind of information from anyone, it's going to be the guy with, a couple $1 million on the line. And that's why I like options. That's why I like using volatility expectations in determining the market conditions. So I pointed out the fact that ATR was sky high over here. And this is actually prime time for range trading. We're going into 2009, which I mentioned earlier was a fantastic time for range trading strategies because we're moving a lot, but not moving in any one direction. We're heading into that kind of market environment here. Great time. ATR keeps us out of the trade. Of course, you see that volatility percentile, which I'll explain a little bit better in a second, ranges from 0 to 100. It is super low down there. Kind of tells you, all right, markets are volatile, sure, but overall, things could be worse. Might be a good time to turn on your range trading system. Sure enough, in theory, you could have made some pretty decent profits looking at this. Now, what I'll point out is that you try to sell there, but notice something here. ATR is basically flat, heading into this breakout right here. And ATR is actually, if anything, trending slightly lower. What do we see down here? Volatility expectations are picking up. So maybe you try to sell there, again, keeping with the fact that price held its support and resistance bands really well. You got blown out. One thing to note, that volatility expectation from the FX options price went through the roof. And that's a big warning sign that says, hey, I know that things have been quiet recently, but all of a sudden, all these guys with significant financial interest in getting it right are all of a sudden saying, I don't want to bet on slow market moves because we might see big ones. And sure enough, that's what we saw. So in my earlier presentation, in the number one reason Forex traders lose, I talked about the fact that I'm talking the RSI strategy all day. And if you don't know the RSI strategy, I'll go over it really quickly. The reason I like the RSI strategy is, again, because it's a poster child for range trading. And I've done correlation studies between hypothetical performance of the RSI strategy and what our traders actually do in their accounts. So I think it's a great proxy of when you should be trading the euro dollar or what have you. If you can start timing the RSI, you give yourself a much better chance of trying to time real-life trades. So the RSI strategy is super simple. When something's really overbought, super expensive, you sell it. When something's super cheap, you buy it. And in concrete terms, you put a 14-period RSI, which is available on any charting platform out there, and you say, you set your overbought levels at 70, oversold at 30. I'm going to sell when the RSI crosses below overbought, and I'm going to buy when it crosses above oversold, so I can try to sell the pullback and buy the bounce. So that works super well when markets aren't going anywhere. When markets are stuck in a range, even if it's a really choppy and volatile range, if they aren't going much of anywhere, you're probably going to do pretty well. Problem is, when markets break out, you're going to do really poorly. So poorly, in fact, that you stand to lose much more than you gained when markets were actually in your favor. What do? We're going to put a filter on this, and the theme of this presentation is going over when do range strategies work. I want to give you a good sense of when we can time range strategies, at least, hypothetically, at least what's worked in the past, so we can have a better sense of what might work in the future. So I'm going back to my volatility expectations. That was the first chart I showed you. When volatility expectations are trending lower, it means that, okay, things are moving, but at the same time, I'm betting on less big moves, smaller moves going forward. Basically means that price ranges are probably contracting, price is probably not going much anywhere, and that's basically what we saw in real back tests and real live tests on range trading strategies in 2009, that when volatility was contracting like this, it was a great time to sell something that was expensive, buy something that's cheap, because nothing's really moving. When things broke out, and again, this goes back to the early 2010, when things really start moving again, when the US dollar enters a really big downtrend, when the Swiss franc starts taking off, terrible time to range trade, and that's exactly what we saw in a lot of strategies. You could have gotten blown out of a lot of those trades, so it was really important to keep that in mind. On dailyfx.com, once a week, I publish what I call the Forex Strategy Outlook, and a lot of colors and a lot of numbers on this table. But what I really want to draw your attention to is right here on the leftmost column, the volatility percentile. So I take volatility expectations from that Euro-US dollar option, and actually specifically on a 3-month option because I found that those work the best. I take the volatility expectations on that 3-month option and compare it to how volatile markets expected the Euro-US dollar to be in the preceding 90 calendar days. And that gives me a percentile. And if you've back tested and you do program a lot, you want to standardize rules. That's basically why I put this percentile across all these currency pairs, to give me a standardized rule to say that the Euro-US dollar volatility could be significantly different from the Australian dollar New Zealand dollar pair, but at the end of the day, I'm comparing them apples to apples, volatility percentile, and that's exactly what we're looking at. When that number's really high, I don't want to range trade. And you can see right here, for instance, in this particular snapshot, that Euro-Swiss franc volatility index percentile was 92%. I favored breakout trading. So using this information, I can say, okay, well, on the Australian dollar Japanese yen pair, volatility expectations are far lower, and I say, yeah, maybe it's time to range trade because the price probably isn't going to go much of anywhere. And the rightmost column is the DailyFX Plus trading systems, a little bit beyond the scope of this presentation. Maybe some of you are familiar with it. We can talk about that a little bit later if we have time. At the end of the day, what I really want you to know is that most traders, and the numbers don't lie, most traders range trade, and you have to be really aware of when range trading works and doesn't work. And I think this is probably one of the best charts I'll show all day. And what it is again, we have the volatility percentiles, in this case, split into an equal 4 quartiles, so 0 to 24, 25 to 49, 50 to 74, 75 to 99, or 100. And what we have is the average trader profit or loss in the Euro-US dollar pair per day, and where the volatility quartile was that day. So basically, I'm taking a look at where we stand in terms of volatility expectations and comparing that to hard numbers, what traders actually made or lost that day. What I really wanted to draw your attention to, and I couldn't have made this up better. Obviously, I tried a lot of stuff that worked and didn't work, but the simplicity and how well this chart worked surprised me by a good chunk. On average, traders were the most profitable when that volatility percentile was really low, when it was in its bottom quartile, when it was between 1 and 25%. On average, traders did the most poorly and on average lost about 2.25 pips when that volatility percentile was at the top quartile. So at the end of the day, you actually see almost a linear relationship between this. And it doesn't work nearly as well across all pairs, I will admit that. But at the same time, when you think about the fact that most traders range trade, and range trading does really poorly when markets are moving a lot, you start to pay attention to the fact that, hey, maybe there's something to this. Maybe there's something to the fact that options traders are pricing in major moves. I want to stay away from the euro-US dollar if I'm going to stick to my current strategy. Really important to keep in mind. So, I'll go back to the RSI trading strategy because, again, I think it's a great proxy for what our traders actually do. They sell something that's expensive. They buy something that's cheap. I want to see how well the RSI strategy has done over the past, 8 or 9 years, give or take, across the US dollar, Swiss franc, sterling dollar, euro dollar, and dollar yen. And just so we know the mechanics of the trade, each of these trades with one standard lot on each signal. So we're using that RSI strategy on a 60-minute chart across all these currency pairs, and we're using 10K lots at a time. So those sterling trades are actually worth a little bit more than the dollar trades because the sterling, between that stretch was worth between $1.50 and $2.10. Something to keep in mind, not overly significant, but those are the actual mechanics of the trade. Overall, the strategy is actually done reasonably well. Now, I'll be the first to admit that we're starting on 10K lots in about 2003. And if we're trading on one-to-one leverage, we're essentially talking about starting with $40,000. At the end of the day, we would end up with about $50,000 over the course of 8 years, in theory, hypothetical. One thing to note, I do build transaction costs into this, so I assume 3 pips for the euro, 4 pips for all of the other 3 pairs. Overall, system's pretty good, pretty decent, not bad, nothing spectacular. But what we do notice is the fact that it's these sizable drawdowns. Again, if we're trading on one-to-one leverage, and we started basically at 2008, when the strategy had a major run-up, we stood to lose nearly $20,000 in not so much time. So at the end of the day, even though the strategy was overall doing pretty well, you have to know when to turn it off because those drawdowns can be substantial. So we go back to that volatility percentile. We go back to our filter that we discussed in the RSI strategy. Let's take a look at what happens next. So let's say that I want to turn off the system when we're in the top quartile, when we're at 75% or higher on those numbers. Right here you see the results. Not as sexy, I know. It can seem a little bit better at times. And overall, it's actually doing okay. Nothing spectacular. A little bit smoother, much smaller drawdowns, I will tell you that. But overall, not bad, decent. Let's try 50th percentile. And this is actually a little bit surprising to me. If you cut it off, basically half of the time, it seems like you leave yourself out of a lot of good situations and leave yourself exposed to the top, a good chunk of volatility anyway. So just cutting it off at the 50th percentile doesn't backtest well on the euro, US dollar, Swiss franc, sterling dollar, and US dollar, Japanese yen pairs. But what I do want to draw your attention to is the fact that when volatility is in its bottom quartile, so when prices aren't moving that much, when options traders are basically saying, I don't think the euro is going to move very much. And let me draw you back to this table right here. When options traders are basically telling you that the euro probably isn't going to move very much, the euro is probably not going to move very much. They have a lot of money on these bets, and they have really good guesses. It's not perfect by any means. I mean, volatility percentiles will probably be at their lowest in the instant of the breakout. That's how these things usually work. But maybe a day or two late, you all of a sudden see that markets are probably going to move a lot. That's exactly what we want to start using. So again, I take you back here. And I'll be the first to admit that this is a lot less sexy in total returns than our baseline RSI strategy. Again, if we're trading on one-to-one leverage, we're starting with $40,000 in 2003, and we're ending about $45,000 in 2011. I compiled these results as of a few weeks ago. Nothing crazy. But at the same time, if you improve your risk-adjusted returns, you can then use this information to vary your leverage. If you can control your maximum risk and you stand to really know when the system's probably going to do better, you can have a better sense of when it's time to really place a little bit more aggressive trades. And what I do want to emphasize, and I flashed the disclaimer a second ago, just because something backtests well, just because it looks good in hindsight doesn't mean it'll do well going forward. That said, it's a better chance. You know, you don't know that it's going to do well in the future, but if I had to guess based on the past 8 years of data, whether or not this is going to do well, I would guess it's probably going to do at least pretty okay. So that's really what it comes down to. When markets are really pricing in major moves, you don't want to be in a range trade. Why? Because you're selling something that's expensive. If it's going to get more expensive, you're probably going to lose a lot of money. And again, it goes back to the fact that our traders fit that mold. When they're right, they're decently right. You know, if you saw my earlier presentation, you saw that on the Euro-US dollar pair, on average, the average winning trade in the Euro-US dollar was 65 pips winners. The average loser was 127 pips of a loss. When you're right most of the time, but you have those kind of ratios, it's really important to know when you're going to be wrong. And more to the point, we were talking about the US dollar Swiss franc pair a lot in the last presentation. We were trying to optimize it so that our equity curve looked a lot better. Well, I briefly alluded to this, but basically, again, we're using the same rules. We're basically saying if markets are pricing in major moves, I don't want to be in this. I want to stop trading my RSI strategy if my volatility percentile is above a certain level. And the way that I structured this percentile filter is if it's above 25%, I don't want anything to do with the RSI strategy. I will close existing positions. I won't take new ones. We saw the dollar Swiss equity curve earlier. It was really good in 2009, for instance, but since then, it's been pretty poor. And you can see it there. Basically, starting in 2010, the dollar Swiss is a huge downtrend. It falls a lot. But at the same time, options traders are pricing in big moves, so we can use that information to avoid this pair altogether, or at the very least, try a different strategy. And in fact, when you compare the baseline, which is in blue here, again, using the same 10K lots on one-to-one leverage, that would be a $10,000 account to start, compared to our filtered strategy. And the final equity is not as high, but I mean, check out these drawdowns. I couldn't have drawn a better equity curve freehand, to be perfectly honest with you. No guarantee that it will work in the future. It does have a better chance of success in the future, in my opinion. So that was basically my presentation. It was a little shorter than my last one, but I want to open the floor for questions. I think I talk about volatility expectations all the time. I talk about FX options a lot. One of my colleagues, Christopher Vecchio, is going to be presenting on FX options tomorrow. He's basically using a lot of the information I did last year, so I definitely recommend checking that out. But basically, it's another place for information on FX markets, like just what traders are doing, what traders are expecting. And really, what I want to emphasize is that that information can be really useful to you. To sum it up here, though, I need you to recognize your trading style. So this was talking about when we can range trade. If you're a range trader, you know, this is the $1,000,000 question right here. When is it a good time to trade the euro? When is it a good time to trade the Swiss franc? Recognize your trading style. And again, I'll say it, recognize your trading style. If you're a breakout trader, these rules don't really apply to you. And I have information for breakout traders too, a little bit later, trading the majors without getting burnt. Recognize your trading style. Adapt to different market conditions. Just because something has been working really well doesn't mean that it's going to work in the future. And I think the biggest part of this is changes in market conditions. So if the euro is bouncing between 150 and 160 for a few months, might lull you into a false sense of security. It'll stay there for a while. And I know it gets boring. But at the same time, you have to adapt when it does break down, and volatility expectations can really give you a better sense of when that's going to happen. Range trading, avoid volatile markets. Breakout trading, avoid slow-moving markets. And I'll cover breakout trading a little bit better when I talk about trading the majors. But basically, what we're looking at is trying to find those situations in which we can use one system over the other. So I thank you again for attending, and I'll open the floor to questions.